Hello, this is Brian Shannon from AlphaTrends.net. Today is Friday, the 25th of January, 2008, and the market's closed. The S&P 500 closed down just about $2, and that'd be a loss of $1.40. 1.46%. As you can see here, the level I said yesterday that we wanted to look for as potential resistance, and that is the August lows. Looks like it almost exactly tagged that level. If you look, though, this low was 137 even, and today's high in there was 136.76. I think that's close enough to say support broken. It looks like it's acting as resistance, and we probably had some selling in there due to the declining 10-day moving average being in that area as well. You can see that once again the volume was just about average for the last 20 days, but in relation to the most recent leg lower, you can see that today's volume was pretty mild. So we had a very large increase in volume on this most recent downward move here in this area. And then we had diminished volume here the last couple days. Now today the market was down, yesterday it was up, but it's tough to say from that volume what the trend really has in store for us. However, the low volume on the rally of the last couple days does point to a little cloud of suspicion. Bullishly, though, you could look at this week as being positive because, first of all, in relation to where it opened down here on Tuesday after we had that panic open and the Federal Reserve cut rates by 75 basis points. Then Wednesday we had another little scare here based on the Apple earnings. But for the week, this VWAP right here, this is the VWAP for the week, meaning the average price that people paid for the S&P 500 spiders here was right at about 131.70. So most people who bought the spiders this week were in a position where they did realize gains by the end of the week. However, it's tough to call that bullish when you've got such a large down trend here present on the daily time frame. And again, we've got the declining 10-day moving average below the declining 20, which is below the declining 50, and that's below the declining 200-day moving average. That says net the sellers are in control of every single time frame here, and that the biggest money, the institutional money, is a net seller of stocks with that declining 200-day moving average. It's not easy to turn the direction of that 200-day moving average, but as we know, it is heading lower, and that's what I've been, kind of saying is really the definition of a bear market is a declining 200-day moving average. Here's the area that we were looking for potentially to hold as support last week based on the prior highs from 2006, about May of 2006, that is, and then this uptrend line as well. And you can see the market is still kind of struggling in that area, but again, clearly nothing bullish here. The market is oversold still, even after the last couple of days of bouncing, and perhaps we get a little bit more bounce, but you've still got to treat this market as guilty till proven innocent, that the trend is clearly lower here. Looking at a 30-minute time frame and looking at this trend line, you can see that it still hasn't breached that level. We've got this area here as well that kind of adds to the significance of that level at about 137.5. That prior support in here that was important on the way down, breaking that level, that is, that 137.5, which led to this leg of the decline, is still right now the market's still below that and acts as resistance. Bullishly, you could say we've got a flattened out 5-day moving average, and the market holds above it. However, today's selling into that gap. You can see that all day it remained below the declining VWAP today. So sellers clearly taking some of the week's gains or gain back of their equity that they're down on, and taking some money off the table before the weekend. So it remains guilty till proven innocent. We're in a terrible downtrend. There's nothing here to indicate that any kind of reversal is at hand, and this rally that we've experienced the last couple of days since the Federal Reserve cut rates, it should be viewed until it gets more constructive as a bounce within a downtrend. The only thing that would change that, in my mind, is it's going to have to get at least back up above this level here near about 144. That would get it back above the 50-day moving average, and I think that would only really serve to put the market more neutral. It definitely wouldn't be bullish. There's still a lot of overhead resistance potentially here in this market. If you take a simple VWAP, even from, let's say, from January of 2007 and straight over, the average price paid from January of 07 was to current closes was about 146.5. If you take it from January of 06, the average price paid in the spiders was 142, and we're well below that. So we've got a couple years worth of losses in here, and we even take it to 2005. You can see that the average price paid over the last 3 years for these spiders is still at 137, or $4 higher. So there's still a lot of people underwater in this market, and support broken tends to act as resistance as people look, as people are frustrated with this type of activity. The headlines grow worse, and people are looking to break even on their investments in the S&P 500, and they look to sell on any strength. So still a lot of work needs to be done before we can consider this anywhere near bullish. And yes, the semiconductors, again, horrible downtrend here in this market. Nothing in here suggesting any kind of turn. If we look at the the 365 level is again an area of what's been resistance here recently, and it's going to need to get at least back above that 365 level before we can consider any type of bounce to materialize that might be able to hold. So getting above and holding above 365, and then if you've got more resistance, potential resistance levels up at 370, up at 390, etc. It's going to be tough going to the upside, in other words. So we've got a flattened out 5-day moving average, but that doesn't make it bullish by any measure. Still just very negative action overall in the markets. The IWM Russell 2000, this market today lost 50 cents, or about 0.72%. The big level of resistance for this market, of course, is likely to be found up near the $73 level. That's the area that we were harping on as it came down and kept testing that as support. And now we're up at that $70 level, finding near-term resistance, which was something that we were looking for as well, that being the $70 level, $69 and $70 level being a level of resistance. And we did close below the 69 and, of course, obviously below 70 as well. Perhaps we're setting up a little inverted head and shoulders. Tough to really have any conviction in that with such a negative daily and weekly time frame. But when the markets get these oversold, and it took out this 2006 low, I think that might have flushed some sellers out of this market. And the people who were, on CNBC at the beginning of the year saying that the mid caps were going to outperform, maybe they're puking their positions out, and perhaps it can rally a little bit. But again, it just looks, low volume rallies within a primary downtrend. All these moving averages heading lower says that if you're going to be trading this thing on the long side, make sure that you're a very disciplined, aggressive trader who can admit defeat very quickly, because the odds just do not favor further upside in here. We're showing a little bit of stabilization, but not really a reason to buy. Getting back above that 70 and holding above there, maybe there's some upside trades for a day or two at the most, but with earnings reports coming out each day and the divergence in the reaction to those numbers, for instance, Apple being down 20 points on earnings, Microsoft being up whatever it was up today. There's still a real mixed, volatile market out there, and it's going to be more of a day trader's environment still. And these wild intraday swings mean that you have to be focusing more on the trends of the 5-minute time frame, the 2-minute time frame, the 1-minute time frame, and looking for your opportunities when the market breaks down, rallies back up, makes a lower high. This level of support, for instance, here at 69.20, became resistance. As the market starts to break back down in here, then that's a good place to sell short and put your stop up in here. Another way to play that, of course, is with the TWM, which is the double inverse IWM, Russell 2000. And, of course, it's going to be the mirror image where we see this resistance acted as support. So you could buy that right in here as the momentum starts to begin again. and then put your stop underneath that level. It's above the rising VWAP. It makes for a good day trade, you know, higher highs and higher lows until that pattern's interrupted right here. Then you want to move to the sidelines, back into cash, and wait for those opportunities. But here, I mean, just looking at this, 84.5 up to, you know, if you got stopped out right over here, 85.5, and that's a nice, you know, 30, 40-minute trade for a dollar, or a little more than 1% in that TWM. So there's great opportunities out there. There's no reason not to be looking for those. And this TWM looking very bullish, by the way. You can see that that was up on big volume. Now it's pulling back on light volume. Just the opposite of what you're seeing, of course, in the IWM. So it's just the mirror image, basically. The NASDAQ 100 was the Qs. These guys lost 92 cents, or 2.05% today. So once again, the Qs were a little bit weaker than the rest of the market. And, you know, we saw big point losers in Apple, you know, down $5.50 today. Google down $8, and some of the, you know, bigger tech stocks are losing multiple points. Now they did have big bounces as well, but this big red candle obviously is very negative. The only good thing about it is, I guess, that it came with lighter volume, but that's definitely not anything to be viewed as constructive or positive in here. Like I said, the August lows were going to continue to be important going forward. Yesterday they closed above them, today back below. Bullishly here on the 4-day VWAP, the market for the week did finish above the average price that it traded at, just barely though. And you know, on the 10-minute time frame though, we've still got this declining 5-day moving average saying you don't want to trust these rallies. And we can look at a 30-minute time frame and see further reason not to trust it, that we've got this downtrend line still solidly intact here. And the key, I think the key resistance for the short term in here is about 46.5 or so in the NASDAQ 100. But again, there's just nothing here that shows anything bullish. So you know, look at the 1-day VWAP in here for today. This is just, you know, selling all day long. It remains a very treacherous environment, a stock picker's environment. So be careful.